name's Ray. This is Jack. And we're here to talk about investing. So I think Christoph and Hugh mentioned Nexus as a capital pool that sits in the middle of the whole thing, backing the covers. And we've been part of a sort of community team that's figuring out ways to earn a return on that capital pool. And we're here today to share our experience of it so far and tell you guys how we think about it. My experience is as an actuary, worked in traditional insurance for a while, but was one of the early employees of Nexus. And I actually stood on the D1 Conf stage in 2018 in Prague, talking about, oh, wouldn't it be great if we, when we raised the capital pool, we had some investment assets, maybe we could go and put them somewhere. And here we are now 4 years later with the whole universe of assets and have actually been doing it, which is yay. Cool. So a bit of background about the investment hub and how we set up. So we started in early 2021 to really kind of do this in a more formalized way. And we got 7 members with skill sets across sort of investing in blockchain and DeFi, some traditional insurance senior professionals who work in their investing teams, and prominent members of the Nexus Mutual community like Jack and a few others. And we got a budget approved from the community fund, and because we were all part-time, we allocated it based on contributions, so we all voted on how much everyone's contributed in a given time period and allocated the budget based on that, which is quite interesting. So what role do we play, and how does an investment go from A to B in the Nexus world? So we kind of sit at the start of the process. Proposals can come in either from us or from the members themselves, and the reviews happen in the same way. So we will scrutinize it, and the members will scrutinize it, but the governance decision ultimately rests in the hands of members. And if that decision is a positive one, which hopefully after going through that it is, then we hand it over to the core team to actually implement it. So that's the technical side of implementation. In reality, you probably have the core team involved in an early stage because you don't want to really push something through that then turns out you can't implement. But that's kind of the general process. So what have we done to date? So we defined the investment philosophy, which Jack will talk about in a bit, kind of the key points around that. I think we've looked at about 25 opportunities. This is kind of a serious investigation once we're like, okay, this could actually happen. And now we need to go dig in, do the due diligence, read through all the economics of it. And to date, we've made 2 investments in staked Ether, so in the Lido protocol. And we've generated, so those 2 investments in total, just under 30,000 ETH. And we've generated about 1,000 ETH from that. I think it's about a 5% weighted return rate per annum. And we're currently got 2 further investments in the pipeline that are being investigated from a technical perspective. Cool. So I will hand over to Jack to talk about philosophy and assets.
Sure. So I think probably everyone here is comfortable with these are kind of generally the risks that we see when we're kind of looking at different opportunities in crypto. I mean, obviously we all face these. Some of them are a little bit specific to insurance. And a lot of them really only come into effect when you're dealing with huge amounts of capital. So if you're just putting a couple $1,000 to work in a DeFi protocol, you probably don't need to worry about liquidity too much. For us, if you're looking at putting 20, 30, $50 million into a protocol, liquidity becomes quite a concern. Our experience has generally been that liquidity for a lot of these protocols is very much like the collateral backing Tether, in that it kind of doesn't exist. So the reality is you end up shrinking down your possible asset of sort of universe of assets by like an order of magnitude. Really, the other ones that are kind of specific to us would obviously be regulatory concerns. The most obvious option, would be to just give capital to a hedge fund or a market maker who's doing things off-chain, and they can generate. Some of the ones we've seen are like upwards of 50% returns per year, with like 3+ Sharpe ratio on like very significant amounts of capital. But obviously, regulatory issues kind of prevent that. You could easily imagine a scenario where you give them the capital, and then there's some sort of regulatory change in their domicile, and they can't give the capital back to you. So getting things off-chain, kind of a no-go. So you're sort of limited, in our case, to things that are going to be on-chain. These are really the way that we think about sort of risk bucketing and benchmarking. Generally, we're talking about holding 10 to 20% of capital in cash. That's really because we're kind of just doing cat bond type stuff where you don't need massive amounts of cash on hand to pay out claims at any given point. We kind of defined low risk assets as staked ETH, some sort of E2 staking option. Currently, as Ray said, we're 20% invested there, with the other 80% sitting in cash where we look for opportunities to invest it. And then medium and high risk. For those of you in traditional insurance, you'll probably be like, well, that's quite a high target allocation for high risk investments. I think what we see so far is that the actual difference between low risk and high risk opportunities is not that big. It's definitely like not comparable to traditional opportunities where you have Siemens bonds, and then on the other end you might have like some sort of equity investment, and there can be quite a different risk profile. For us, the difference between something low and high risk might be relatively minute and might be in terms of liquidity rather than the underlying asset itself. So one thing we kind of focused on heavily is ETH2 staking, and that's just because right now, nearly 100% of the assets for the mutual are ETH or staked ETH. One of the big pros really is allowing the mutual to remain long ETH. Ultimately, the mutual runs based on what the members want. The members want to stay long ETH because people generally people are generally bullish ETH in this space. So while we might have liabilities that shift more towards stable coins, we're lucky that right now we're quite heavily overcapitalized, and so we can afford to have a little bit of an asset liability mismatch there and remain long ETH. On the con side, I think really the big things that we think about are what is the risk specific to the different node operators. That might be geographic, that might be what kind of guidelines and rules do they have to follow in order to like recover from events and downtime. And I kind of touched a little bit earlier on centralized managers. This is really probably the best risk return that I think people can get in the crypto space right now. But we're kind of off limits to this just because liquidity is essentially zero. You end up doing quarterly or annual redemptions. That doesn't really work when at any point you might need the capital to pay out claims. Obviously, you have low to no protocol risk, especially if people are doing market making. At that point, really, the main risk you're taking on is the counterparty risk and obviously the risk of the exchange itself. In this case, like if it's a Kraken or a Coinbase, it's relatively minor compared to what you might see when you're looking at DeFi protocols. Another benefit is obviously having some sort of guarantee in form of legal agreements. It's always nice to be able to sue people if you want your money back. And I think Ray's going to talk a little bit about the DeFi protocols.
Yeah, so this is another area that we're actively investigating, and probably the greatest variety here in terms of what you could invest in. So, a sort of Uniswap automated market maker being a liquidity provider for that is very different compared to putting it even in Aave or Compound, never mind all the hundreds of different things built on top of those. Here, I think we like that, these are also protocols trying to build a permissionless finance system, and, we very much like fitting into that system of money Legos. And also the technical implementation, while not easy, is possible. You know, these are people speaking the same language and the devs speak the same language. And often the liquidity is quite high compared to, I think Jack mentioned that with kind of centralized providers, it's harder to do that, but here we can buy and sell whenever we want to. On the downsides, it's very easy for us to run into concentration risk issues. So that kind of goes both because we're protecting these protocols, but also putting a portion of our capital in those protocols, and that's not a very good thing. Then if one breaks, then all of a sudden we left with very little. Protocol risk of the kind that I think Peter talked about was very, and that we also cover is very high here. The returns can be very variable, and I guess linked to the next point is that it requires active management. So often a new yield farm will come out, not that we particularly tend to go for those because of the risk profile, but a yield farm will come out and offer you 100% returns for 2 weeks, but then go to almost nothing a week later, and we see quite a lot of that in this space. Those kind of the three broad categories of things that we think about. I guess just to finish off on some lessons from our experience, so hopefully if someone is thinking of deploying their crypto in an institutional sort of way, what is there to think about? Well, I'm surprised to know when the space moves very quickly and you have to keep your eyes peeled for opportunities all the time. Have to be very thorough. I guess, in traditional finance, maybe one bond is not that different from another, whereas here every protocol has its own idiosyncrasies, and same goes with the teams underlying those protocols. It's not a standalone activity. You had to really get the tech team involved early to identify any issues and any other teams that might be relevant to this. Integrating with other protocols is a lot of work, and dev resource is probably the most constrained thing in Ethereum right now. And I guess the conclusion is it's a hard problem, it's a unique problem. There's liquidity issues, technical issues, concentration issues, diligence issues, and tax issues, and compliance issues. But it is doable, and it's certainly important, to be able to do this in a proper way. So yeah, I think, from a Nexus community perspective, open call to get involved for those who want to, and think that if you have good ideas, then we're happy to hear them on the forum and in the Discord, etc. I guess, yeah. So thank you. This is a very brief fly-through. We couldn't go into a lot of detail because of the sort of time constraints and people want to break, but very happy to talk to anyone after the presentation and take a few questions now as well. Thank you. Yes, Gustav.
How transparent are you over the process? So the process of selecting and discussing, evaluating, is it something what happens under the eyes of your public community, or is it in a closed shop? And if it's public, could there be a specific risk in doing this in public?
So for the DeFi stuff and for the staked Ether, we tend to, one of the members will draft a proposal and it will go on the forum to be debated straight away. With some of the centralized providers, they are not open to that sort of thing, so we are not quite as fully see-through, but ultimately anything that we approve has to go to member governance, so it has to be open before it gets implemented in some way.
Yeah, I guess one of the most obvious problems with that is you can just get front-run on things pretty hard. And if you're putting a very significant amount of capital into something that's kind of liquid, that obviously becomes a problem. I mean, or anyone who's followed the buyback process that we've gone through, you just get front-run all day. But that's kind of the trade-off with DeFi in general, right, and anything that's decentralized, you know, you always trade off that transparency. You know, you get traded off for people front running you.
How diversified are your DeFi positions? Like how much, like what assets do you invest, like on the spectrum?
So currently, I think we have about 80% in ETH and 20% in staked ETH. So not very diversified at the moment.
What about Rocket?
Yes, very interesting protocol. I guess the liquidity is still a bit low. I think we find it's quite uncomfortable for us to be a huge portion of the underlying asset.
Yeah.
But yeah, I think we're looking at all the staking providers and monitoring them very closely.
Yeah, I think last time I looked, Rocket Pool's like 1% of the size of Lido, and we're like the third biggest staker in Lido. So already that liquidity on Lido becomes like a little bit uncomfortable in terms of like, you know, post-merge wanting to actually get out. That's going to be tough. Slippage probably pretty serious there. I mean, we are looking at Rocket Pool pretty openly. I mean, we discussed it on the forum, I think. I think one of the big blockers right now is like they don't have a Chainlink oracle. So getting like an accurate data feed for what the actual price is, that's quite important. So Chainlink, we've talked to them about getting it set up. My understanding is like Rocket Pool don't have enough pools with enough volume per day. So there's not like a good data feed or something. Once that's solved, Rocket Pool is like obviously a pretty obvious place to stake.
Yeah, I guess that oracle problem goes more widely as well, because a lot of the DeFi stuff that we look at, we need that instant feed to know exactly how much money there is in the pool, so that you can back covers accurately. And if there isn't a reliable oracle that gets updated in real time, then it doesn't quite work for us. Yeah, at the back.
Thank you. Great. Thank you. Very interesting talk. All the risks you classified were like inter-ecosystem risks. So all your risks are inside the Ethereum ecosystem, in the wider Ethereum ecosystem. But when you price risks, you also price like international exchange rate risks or stuff like this. So do you also have some kind of mechanism to price like what you do in the Ether space versus what happens in the fiat space or with other currencies, cryptocurrencies?
Yeah, I don't think all of them are exclusive to just the Ethereum ecosystem. So, for example, illiquidity is very much a centralized issue to get it to us. Counterparty risk, I think we had on the list there, which is very comparable to kind of traditional counterparty. Yeah.
In your talk, you were always looking at, okay, this DeFi protocol has this problem, but you never like talked about like, okay, what happens if Ether versus the dollar slips and you can't get out in fiat for business expenses and stuff like this. So you were only looking at one ecosystem you're part of, but not the other outside ecosystems like fiat.
Yes. So there is. This is slightly separate from the community fund and from the foundation, which kind of deals a lot with the real world. There is certainly an ALM piece for us to have a look at, but I think Jack mentioned our members really enjoy being long ETH, so we focus on that at the moment. But yeah, that's definitely in the works to create a closer asset liability match. Okay. Well, thank you very much, everyone. Appreciate it.